that accounting is full of nuances. We're going to go through 6 nuances related to equity method accounting. And stay to the end. I'm going to give a bonus nuance related to equity method accounting. So you definitely want to hear that last little piece of information. And I want to know in the comments below, did you know any of these 6? Let me know which ones you knew and let me know which ones you did not know. Now, our first one we're going to go through is when you recognize an equity method investment, there is a fair value aspect of it. You're going to follow ASC 805, which is business combinations, and you're going to apply it to the equity method investment. Even though it's technically not a business combination, it kind of is because you're bringing in a one-line investment pro rata portion of the ownership of that investment. Now let's go through this really quick. This is Sparta Incorporated buying a 25% interest in Thermopylae Holdings. Now, they bought it for $1 million. They got 10,000 shares of common stock. There's 40,000 issued and outstanding. That is the 25% ownership. We're going to do several calculations. We're going to look at the book value of the equity method investment. We're going to look at the fair market value from the appraisal of Thermopylae Holdings. And we're going to eventually see if there's any goodwill related to our $1 million investment. So first thing we need to do is get the book value. We need the balance sheet of Thermopylae Holdings, and we need to see what our 25% investment gets us from the balance sheet standpoint. This is our book value. So I'm just going to take their balance sheet, and I'm just going to take 25% of the assets and 25% of the liabilities and get my net assets. So from a book value standpoint, Sparta Incorporated's 25% investment in Thermopylae Holdings gets us net assets of $625,000. Now, an appraisal was done in this situation. We had an independent appraisal done to fair value any assets that were greater than book value. So we're going to go through the same motions, except this is an appraised balance sheet with fair market value adjustments factored. And the one adjustment we have here is for the fixed assets. So we went through the motions there. From an appraised asset standpoint, our net assets are $750,000. So we need to look at what exactly is causing that difference. It's the fixed assets, as we stated. We found out there's a $125,000 difference. It's a 10-year asset from the appraisal that we received. So when we go to do our equity method accounting each year, when we go to do that calculation, we need to depreciate the excess over book value when we go to record our equity income. So in this instance, we have $125,000 excess from the fair value appraisal. That's over a 10-year period. So we're going to take $125,000 of excess fair market value divided by 10, and we're going to depreciate that excess asset over the 10 years, and we're going to recognize $12,500. Now, I know it's depreciation from the calculation we did, but it's just going to be an adjustment to our equity method earnings. So when we are recognizing our pro rata portion of Thermopylae Holdings, we're also going to factor in this depreciation, which is just going to be an adjustment to the equity method income. So this instance, each year we're going to recognize $12,500 of equity income expense. You want to call it that. It's effectively reducing the investment in Thermopylae Holdings for recognizing the fair market adjustment up for the fixed assets from the appraisal that we recognize during the ASC 805 business combinations approach to our investment in Thermopylae Holdings. That is a pretty big nuance related to equity income, especially when you're looking at trading securities and available for sale securities. This is just next level, almost getting to the point where you're doing full consolidation accounting. Now, obviously, you need control to do consolidation accounting, not significant influence like we have in this situation for equity method accounting. All right, number 2, we're going to continue what we're just doing, but we're going to finalize the initial investment in Thermopylae Holdings. Now, you saw we previously brought in the book value And then we're also recognizing the fair value adjustment for the fixed assets. Now you can see that doesn't fully add up to $1 million, which was our investment in Thermopylae Holdings. So Sparta Inc. is going to figure out what do we do with that $250,000? We paid $1 million. It looks like our fair value adjustment over our book value is only $750,000. The difference between the book value and fair value adjustment is going to be goodwill. This is going to be identical to what happens with business combinations. When you make an investment, you assign your assets, you assign your fair value adjustments for the assets that you bought. Anything over the assets that you had purchased is going to be goodwill. Easy math here. $1 million divided by $1 million minus $750,000 is going to be $250,000 of goodwill. So our breakdown of the initial investment of Thermopylae Holdings is a book value of $625,000, a fair value adjustment for the fixed assets of $125,000, and then the excess over our investment was goodwill at $250,000. And goodwill for equity method investments is not tested for impairment. So we're going to do nothing with the goodwill. The ASC is related to that. ASC 350-20-35-59, equity method goodwill impairment is not reviewed. In ASC 350-20-35-58, this is where equity method investments as a whole are reviewed for impairment. So goodwill as a standalone isn't tested or reviewed. The investment as an entirety will be reviewed for impairment. If you need a refresher related to equity method accounting, you just watch the first two parts of this and you're like, whoa, that's way too technical. I'm going to link a video in the description to give the basics around. That might be worth watching before continuing in this video. So go watch that if you're not feeling comfortable with equity method accounting. This is nuance number 3, other comprehensive income. When you have an equity method investment and you're starting to recognize equity method earnings, you also need to look at other comprehensive income because ASC 323-10-35-18 states that investors shall recognize its proportionate share of the investee's equity adjustments of OCI, other comprehensive income, as increases or decreases of the investment account with corresponding adjustments in equity method OCI of the investor. That's a mouthful. So when we're looking at the financials, we definitely want to get a look at net income because that's going to be your equity method income. But we also need to look at OCI, other comprehensive income, because you need to know if there's adjustments to available for sale securities, maybe there's currency. We need to recognize our pro rata portion of OCI. So in this instance, Thermopylae Holdings does have adjustments, has fair market value adjustments related to available for sale securities that they own. So in this situation, we're going to recognize 25% of OCI, other comprehensive income. So it's going to be $3,250. That's going to increase our investment. Here's the journal entry. Where you'll find this journal entry on Sparta Incorporated's books is in other comprehensive income equity method investee. We're not going to recognize this in our normal income statement. We are going to recognize it in other comprehensive income. So you'll find this in the equity section of the balance sheet and also in the section related to other comprehensive income. If you've gotten any value out of this video so far, please smash that like button. It helps this video, and consider subscribing. All right, let's move on to nuance number 4. Nuance number 4 involves timeliness of reporting from the investee's financials. If it's not received in a timely basis, ASC 323-10-35-6 states if financial statements of an investee are not sufficiently timely for an investor to apply the current year's equity method accounting, the investor ordinarily shall record its share of the earnings or losses of an investee from the most recent available financial statement. The lag in reporting should be consistent from period to period. Now, ASC is acknowledging that you might not have the information you need to recognize the full equity method accounting related to your investment. They're saying be consistent on what you're recognizing. If you have rolling year financials, keep that same rolling year financials in next year. Make it comparable year over year, knowing that you're not necessarily getting the full 12 months of that investment in your financials. Nuance number 5, ISCS, in substance common stock. What in the world is that? ASC 323-10-15-13. It addresses other types of stock, primarily preferred stock, and whether equity method accounting can be used for preferred stock. So let's go into some nuances related to that. Does preferred stock get equity method accounting? Well, it depends. Preferred stock would be considered ISCS, in substance common stock, if it has substantial rights similar to common stock. This would be voting rights on significant corporate matters and participating in earnings or residual returns that are similar to common stock. And it does not have preferential rights that put it ahead of the common stockholders. Preferences that prevent in-substance common stock will include fixed or cumulative dividends, liquidation preferences, and redemption rights that prioritize it over common stock. If you see those types of clauses when you're looking at your investment, more than likely you're going to get scoped out and you're going to come to one or two conclusions. You're either going to give the preferred stock fair value treatment available for sale trading securities, but if you don't have a market price or the preferred stock just doesn't get valued, you're more than likely going to hold that preferred stock at cost. Our 6th nuance related to equity method accounting. And I did not realize this when I initially looked into equity method accounting, but you can recognize cost related to acquiring the investment. Now, it's direct cost. It needs to be out-of-pocket cost or incremental cost directly related to the equity method investment. Examples will include finder's fees, fees paid to outside consultants to obtain the investment, and accounting and legal costs related to obtaining the investment, along with appraisals as well. Now, any internal costs are completely scoped out of this. If you have internal costs that are looking into this investment, those are just going to be expensed as incurred. But if you do have outside costs related to acquiring this investment, you can include them as part of the investment. So let's go through an example here. With Thermopylae Holdings, Sparta Incorporated paid the $1 million, but they also incurred $50,000 of legal fees related to acquiring the investment. In that situation, when we recognize the initial investment in Thermopylae Holdings, we can include that $50,000. So in this instance, we have $1,050,000 as our starting investment in Thermopylae Holdings. All right, our bonus add-in related to equity method accounting is equity method investments cannot go below zero. You have to look at your facts and circumstances related to your equity method investment and see why it potentially went below zero. Now, if it's related to losses, you're not going to recognize any losses beyond your cost basis in the investment. Now, if it's return from dividends or distributions, you need to look at the facts and circumstances related to the distributions. For example, are they recallable? If you hit the right circumstance, there might be a situation where you actually recognize a gain if your distributions go beyond your cost basis in your equity method investment. Just want to acknowledge that you should never see an equity method investment in the negative when you're looking on the balance sheet. The lowest you can go is zero. Those are some nuances related to equity method accounting. And comment below, how many did you know? Did you know all 6? Did you know 4 of those? Let me know how many of those nuances you actually knew. All right, have a good rest of the day, and I will see you in the next video. Take care, and goodbye.